If we look at publication 4012, and this is tab J, J like jack-o'-lantern. So if you could be there and work along with us, that would be great. Tax treatment of scholarship and fellowship. Now, scholarships are one thing. In my experience, what we're generally looking at is Pell Grants. Pell Grants is the engine that drives a lot of education for folks who have need in terms of assistance with education. Pell Grants is the big one. Pell Grants, when we think about whether something is taxable or not, a Pell Grant is part of the discussion. Okay, so if somebody said, well, if you said to someone, did you get a scholarship or fellowship? My students would answer no, because what they got was a Pell Grant, right? So they wouldn't answer it that way. So you and I need to be aware scholarship, fellowship includes Pell Grants. What is an education expense? And in fact, let me back up just a second. And right at the top of J1, we see that scholarships, fellowships, Pell Grants, and I won't say that every time, but just be aware that that is part of it, is tax-free if we get these criteria. They're a candidate for a degree. You know, somebody who takes one class as a professional development, but they're not in a program, they're not in a degree. In fact, if you went to the college, to the university, they may very well say on their record that they are an undeclared, or something like that. Okay, or non-degree seeking would probably be better. Maybe undeclared wasn't a good example. Non-degree seeking, formally within the system. You know, they're taking one class, right? They've got an interest in a subject. So you need somebody who is in a degree program. You know, they're working towards, or at least potentially they're working towards a degree. Maybe they really, in a sense, maybe they kind of doubt they may get there, but they are at least on that path. The scholarship is tax-free only to the extent that it doesn't exceed qualified education expense, and that it's not designated for another purpose, and that it doesn't represent payment for services, like teaching. So, scenario one, they get a $4,000 Pell Grant. They have education expenses of $3,000. $1,000 of it's taxable. Scenario two, they get a $4,000 scholarship, all of which is designated room and board. $4,000 is taxable. Third scenario, they get a $4,000 scholarship, but they have to be a teaching assistant in order to qualify for it. All of it's taxable. Okay, so we have kind of different scenarios out there. The most common, though, is here's the grant, here's the scholarship, here are the education expenses. Do we have enough education expenses so that none of that grant is taxable? And frankly, guys, we're challenged with that a lot. Sometimes these grants are like this, and the education expenses are like this. That's very common for us. Very common for us. Okay. All right. So what is an education expense? Tuition and fees, yeah, obviously, or pretty close to obviously. And then course-related expenses that are required for the courses. Not required for enrollment. Required for the courses. You know, it's like if you went to my accounting 4 class and you looked into the detail of it, you would go in and it would say textbook information. And you'd go in and you'd find that there's a textbook and you'd see a box checked required. You know, that was a choice I made, right? When I put in my textbook for the course, I was asked, is it required or not? And I say, yes, it is required. Okay, so my textbook would work. Now, you may find that there's a class where this textbook is required and this one is suggested. Okay, this one works, this one doesn't. Okay, so we need required books. Someone bought a laptop. Okay, is a laptop required for the course? There are programs where they are. Most often, they're not.
When you're looking at books, obviously there's lots of different costs. There's used, there's rent, there's buy brand new. Do we take the most expensive one and use that cost?
We take what they spent. We take what they spent on a required textbook. So if they spent $12 on a required textbook, we use 12. If they spend $120, we use $120. If they found a bargain, whatever they wrote the check for.
Okay.
Back to the fellowship and scholarship. Basically, are you saying if somebody gets a grant and it ends up that they get a refund check, they get a check given to them, that amount that they get given to them is taxable?
No.
No.
I'm saying that maybe it's close to that.
Okay.
But what I'm saying is that there are expenses that can be over and above what the institution is recognizing. I mean, the refund comes to you. Well, what did they take out of the refund? Maybe they took out the tuition fees almost certainly, and maybe they took out a textbook or two. But then our taxpayer bought some other textbooks on their own. So I'd say, Kathy, that it's close, but it's not one and the same.
Okay.
Yeah. And then we've got a worksheet, and really, when we're working with students. This worksheet should be part of our world almost every time. We don't just we're not there just kind of imagining it. We should get this worksheet out, or at least something that resembles this worksheet, and actually work through it. Okay, and it becomes fairly straightforward once we do that. This is not, we're really not building the next generation of computer chip here, right? This is pretty straightforward for us. Just do the worksheet. Notice that note 1, we can take, and this is something that's been evolving, but I noticed that IRS is very much more. They're much more outspoken about this year than I've ever seen before. There are situations where income that could be non-taxable could be treated as taxable so that you get an education credit or better education credit. That's note 1 here. We at our CAP services sites, we consider those situations to be out of scope. But just be aware that there is sort of a way to make the education credits better by treating something as income that might not need to be income, but again, out of scope, and really almost out of scope for us for almost non-tax reasons, because we are concerned that including income that doesn't have to be included might have ramifications for non-tax issues, such as benefits of some sort. And we're not in a position to analyze that. So we're considering that out of scope for us. And I think I shouldn't really say I would speculate that many Vitus sites would take the same position. Okay, next slide. And it kind of looks the same because the header is the same. Highlights of education, pages J2 through J3. I'm not going to walk us through each of these guys, but this is a wonderful grid that kind of breaks down all of the myriad tax benefits that are associated with education. We've just talked about scholarships, fellowships, grants, tuition reduction. We're going to talk a little bit more about American Opportunity and Lifetime Learning. Notice student loan interest deduction. Student loan interest deduction usually not very hard for us because they're going to bring in a form, and I think it's 1098E. No, that's 1098.
T is tuition.
T is tuition. I think it's 1098E.
You're right.
That they'll bring to us. So they'll actually kind of bring us that number. So student loan interest is not much. The other ones, frankly, we're not going to see much of. So I'm not really going to focus there. So scholarships and fellowships, that's an issue at our desks. American Opportunity, Lifetime Learning, That's an issue at our desk and can be a fairly big issue in some cases. And student loan interest, that's going to be an issue for us. The rest of them are great. They may apply, but I don't consider them going to apply a whole lot. Let's look at page J5, education credits. This is really just an overview, kind of a quick comparison between American Opportunity and Lifetime Learning. Here's the Cliff Notes version of American Opportunity and Lifetime Learning. American Opportunity are for our at least half-time undergraduate students, right? Our technical college students, almost certainly. Our UWSP students, almost certainly, if they're still undergrads. Now there are exceptions to that. It's the rule isn't undergrad or technical college. The rule's a little different than that, but in general, that's what the American Opportunity Credit is all about. At least half-time, technical college, community college, undergrad at a 4-year school, that's American Opportunity Credit. Lifetime Learning, for those who are either less than half-time undergrads, community college, technical college students, or master's program students. By and large, that's kind of how it breaks down. Lifetime Learning also applies just simply to people who are getting like professional education, just, enhancing their professional skills. Lifetime Learning is pretty loosey-goosey in terms of what qualifies for it. Okay, it's not nearly as sort of detail-oriented as American Opportunity. Let's look at American Opportunity quick. Up to $2,500 per student. Okay, so, you've got, almost God forbid, we've got a taxpayer and they've got 6 of their children in college at one time, right? They could get $2,500 for each of them. They could get up to $15,000 on that. That is per student. Lifetime Learning, $2,000 per return. You could have 100 students, and $2,000 is the most you'll ever see for the Lifetime Learning Credit, regardless of how many students are involved. American Opportunity, 4 years. And look down below, right at the bottom of J5. There are really 2 4-year tests. The first being that they need to be within the first 4 years of post-secondary education. Okay, a freshman, junior, sophomore, or a freshman, sophomore, junior, senior. 5th year, 6th year doesn't work, even though they haven't gotten their undergraduate degree. That's why I say we can't really just say bachelor's degree or for an associate degree. We can't really say those words because it doesn't define like that. It's first 4 years of post-secondary education. And the second 4-year test is that we can never claim this credit for that student on more than 4 tax returns. Now, they tend to kind of hang out together, the one sort of leads the other. So, the first 4 years of post-secondary and claiming it 4 times tend to kind of be pretty similar to each other, but they are different rules, and we need to look at them on their own. Because we could have somebody who's taking like half time, right? Claim it year 1, claim it year 2, claim it year 3, claim it year 4, but they're only going half time. So what have they really done? They've really just finished their 2nd year of college, right? So again, they hang out together a lot of times, but they're not one and the same.
What if that same student didn't claim it one of those years? Could they claim it a 4th year?
Sure, they didn't claim their name wasn't used as a student on 1 year when they were a student. Well, that wouldn't count against the 4 tax returns, but they would still be earning credits and becoming maybe past the first 4 years of post-secondary.
Okay.
Yeah. Okay. The Lifetime Learning Credit, all years of post-secondary. Okay, again, a little bit looser. American Opportunity, potentially 40% refundable. Refundable being that, and I know a lot of people in the room know this, so don't think that I assume you don't know this. A refundable credit is a credit that the taxpayer is going to get the benefit of whether or not they have any tax liability. A non-refundable credit is one that can only be used to reduce their tax liability. And once their tax liability gets to zero, the credit doesn't help them anymore. So the American Opportunity Credit is in general a non-refundable credit, but they say, well, 40% of it we can use as refundable. Okay. Now, somebody with a whole bunch of tax liability doesn't matter, right? Because they're going to use the refundable credit and non-refundable credit just to reduce their tax liability. It's those who use up all their tax liability, that's when refundable versus non-refundable becomes really important, right? Because if it's not refundable and they don't have any tax liability, it's just like, oh, that was interesting. You know, there's a credit there, but you get no good out of it. Lifetime learning is just purely non-refundable. American Opportunity, student must be pursuing a degree. Lifetime learning, they don't need to be pursuing a degree. American Opportunity, student must be half-time. Lifetime learning, doesn't matter if they're half-time. American Opportunity, no felony drug conviction. Lifetime learning, felony drug conviction doesn't matter. American Opportunity Credit, credit reduced when AGI is between 80 and 90, 160, 180 for marrieds. For lifetime learning, it is even lower than that. And we often, in private practice, if you're in a CPA office, you see people running into these limits all the time. We don't see the limits so much at a Vitus site. Okay? So, you know, a beautiful sort of overview right there. Let's look at J6. Let's look at J6. Now, here's where we could almost kind of go on and on and on and on, because there are complexities built into this stuff that aren't apparent when we first look at it. And one of those, very interesting for us, is who can claim a dependent's expenses. This violates, or at least this is different than almost any tax rule you're going to see. And basically what it says is that regardless of who paid that dependent's expenses, all of those expenses are going to be available to one taxpayer. Okay, so let's look at it. If the taxpayer claims an exemption, then the taxpayer can claim the credit based on that dependent's expenses. The dependent can't claim it. Well, that almost looks obvious. But what isn't obvious is that if mom and dad claim Johnny and Uncle Joe claimed or paid for all of Johnny's college costs, mom and dad get the credit, the whole credit. So anybody who pays, if it's not being considered with tax-free funds, anybody who pays is going to be counted for that student's American Opportunity Credit. Okay, and I guess even lifetime learning for that matter, even though most times it would be American Opportunity Credit. So in other words, in that case, the expenses follow the exemption, even if mom and dad didn't pay it. So mom and dad paid a third of the tuition. The student paid a third of the tuition. The dependent paid a third. And Uncle Joe paid a third. Mom and dad, if they're claiming the dependent, they get every penny of it to use for their credit. Okay. Now, what if mom and dad can claim the dependent but don't? Then the dependent gets to use them on their own return. But that doesn't mean, guys, that they are not a dependent, or at least being treated as a dependent for other tax purposes. They are. It's just that this gives a family choices. You know, maybe mom and dad are 62 years old and retired, and they don't even file a darn tax return. Okay? And let's say that for some reason they just feel like they would rather if their dependent took advantage of the credit. Okay? Mom and dad can basically say, we're going to step back. We're not going to claim you. You go ahead and file your own return, which they would need to be doing anyways, and you take the education credit. Well, but what I want to make the point is that that's fairly straightforward, that mom and dad can defer to the dependent. That's okay. But one thing I want to make the point of, and that does not make that dependent not a dependent. They're still a dependent, and they still need to be taxed like a dependent. Okay? It's just that on their return, that dependent can file the education credit and take advantage of it themselves. Okay. Who can't claim the credit? Well, married filing separate. Married filing separate, by the way. Anybody married filing separate, we don't do the return. We talked about that last week. Anyone who's listed as a dependent. Now, remember that little scenario we just talked about, that was they could have been claimed, but weren't claimed. Mom and dad decided we will not claim you. Even though we have that right, we're not going to claim you. You go ahead and take the education credit. Income matters and non-resident aliens. What expenses qualify? For an academic period starting in 2016 or the first 3 months of 17. But guys, don't read that to mean that it's for expenses paid in 2016 and those paid in the first 3 months of the next year. No, it doesn't mean that. It means expenses paid during 2016, but we can have someone paying in December, for instance, for a term that starts in January. But we still need it being paid during 2016. Cash basis taxpayers, right? They need to write the check between January 1 and December 31st. But it can apply to terms that start soon thereafter. Okay. You know, prepaying before the year starts. Expenses now refunded and proceeds paid with loan. You know, paid with loan, absolutely legitimate. You know, it's just a loan. They have to pay it back, right? So it's an obligation of theirs. Sure, that loan money being used for this is absolutely good money being used. What are qualified expenses? Tuition-related expenses. It's expanded for American Opportunity to include course materials. For this purpose, course materials, book supplies, equipment needed for a course of study, whether or not purchased from the institution as a condition of attendance. So, you know, that book that is bought extra, that is not bought through the bookstore, yeah, it's absolutely good for the American Opportunity Credit. It's freer. So American Opportunity Credit, we want to know about all their tuition. We want to know about all their books. We want to know all about their supplies. We're not really saying, is that required or did you buy that through the school? No, we're not asking those questions. But one thing that I need to make a point of, and I really don't have it laid out here so much. Well, maybe we do. But in fact, let's keep going here. What is tax-free educational system? What is the key? Why is that important? We can't take a credit for tuition, books, supplies, etc., paid with tax-free funds. So here's our scenario. Someone gets a Pell Grant of $4,000. Their education expenses are $4,000. There's no credit unless they make that out-of-scope choice to include the Pell Grant in their income, which they don't have to, but they make the choice to, and again, that puts it out of scope for us. Okay, so never forget that. And in our Vitus site, that is almost always the case. Okay, education credits evaporate a lot of times when we see how much tax-free aid is being used to pay tuition. Okay, so never forget that. And it's right on the 1098T too, and so it kind of brings it to our attention that there is some tax-free funds going on. Okay. All right. J10. Now this is sort of a, I don't know. This is one that is sort of, it gets really detailed. It has to do with, in fact, you know what, guys? I looked at this morning, and I'm almost going to take us back to page J5. I'm almost going to take us back to J5. And let me pull this up. In fact, I'm just going to pull that up, and I probably should have done a little bit more of this as we went along. So sorry about that. J5, I think, even shows it better. The American Opportunity Credit is refundable up to 40%, but there's a category of individuals that can't do it. The credit is refundable if the taxpayer claiming the credit is either under age 18, fine, age 18 at the end of the year, and their earned income was less than 1/2 of their own support. So that is specifically an 18-year-old at the end of the year. So that letter B relates only to those who on December 31st, 2016 were 18 years old. Not 17, not 16, not 19, not 22. 18 years old. And their earned income was less than 1/2 of their own support. Or letter C, a full-time student over 18 and under 24, and their earned income was less than 1/2 their own support. So in other words, our 19, 20, 21, 22, and 23-year-olds, if their earned income was less than 1/2 of their own support, and they were a full-time student. American Opportunity Credit is based on half-time students. This rule is full-time students. So under 18, if you're under 18, go for it. If you're 18 and earned income is less than 1/2 of their support, go for it. If they're 19, 20, 21, 22, 23, and a full-time student, and their earned income is less than 1/2 of their support, then go for it. Taxpayer has at least one living parent, and the taxpayer doesn't file a joint return. So we've kind of got some, American Opportunity Credit, yes. Don't worry about these rules in general. But when we talk specifically about a refundable credit, we've got to run them through the prism of these ages and these various circumstances, okay? Really a complication to it, really a complication, and not easy to read or to kind of, comprehend. It's not an easy piece of things there.